My next guest says it's not today you need to worry about, it's down the road. He's making a big call, a really big call. He says the S&P 500 may fall to 400 in a year. 400. I mean, what does he see that investors riding the current rally don't? David Tice is the bear market strategist at Federated Investors, and he's always looked through a different prism than everybody else. David, what is it, and what would effectuate this? You've made other calls before where the S&P would plummet, but tell me what you see now on the horizon.
Well, Liz, we've been talking about this massive credit bubble for more than 10 years, and the credit bubble was pierced in '08. In '09, we brought the economy back a little bit through massive government spending to a tune of, the Investigator General from TARP said it might cost the taxpayer $23 trillion. So it's generated a little bit of growth, a little bit of better earnings than expectations. However, the Fed's going to stop buying treasuries in their quantitative easing program right now. There's a potential for a funding crisis down the road. Around the world, there's too much government debt that's looking for a home with long-term investors. And we just think consumer confidence was 6 points below what was expected, down 6 points from last month. And the present situation level is at 26-year lows. Okay,
but if we don't see this start to move, a massive correction that you're calling for, I mean, we're at 1,063 for the S&P. You say it'll go down to just 400 points. What would you then say? Would you say, well, the government's still propping up this situation and making it look shinier than it really is?
This has been a rally off the 666 low back in March. However, it is not atypical for the first leg down, and then you have a rally. And then you have another leg down, and then there will be rallies, declines, rallies, etc. We think this market is very similar to what happened in Japan when it peaked in 1990, in U.S. when it peaked in 1929. Both those had massive first declines, then significant rallies, and then decline, rally, decline, rally. However, the lows tended to take out each and every low.
You know, the last time you were on here on Fox Business, you said that gold would be set to rally, and sure enough, in the past 30 days, it has. It's gone well above $1,000 per troy ounce. Where does that go from here, David? Should people remain in gold, and if they haven't gotten in, should they get in, or should they pare back their positions?
We think every individual should hold some gold or silver because we have an environment of fiat money where we've never seen anything like this around the world, where credit's being created. The Federal Reserve is buying government obligations. They're buying mortgage-backed securities, agency debt, etc. It's happening in several countries around the world. This is a very problematic period for currencies, and therefore gold represents a bastion of stability and a bastion of discipline.
But what do you like now? You know, just because you're a bear doesn't mean you're not buying certain things. What are you putting your and clients' money into at the moment? You just mentioned currencies. Are there some foreign currencies that are perhaps a little more obscure that seem to really be rallying?
Well, I'm no longer the portfolio manager of the Prudent Bear Fund or the Prudent Global Income Fund. You mentioned currencies. Our Prudent Global Income Fund is a great fund that invests in sovereign debt obligations of major trading partners whose currencies we think will appreciate relative to the dollar. We're very diversified there. We own the Canadian dollar, the Norwegian krona, we do on the Swiss franc, etc.
Okay, so there are some currencies that you like. You know, what makes you most fearful right now? You've talked about how the government is really propping up this economy, but, you know, we also have a very weak employment picture at the moment. How does that figure into your bear strategy and what you see ahead?
Well, we're certainly losing about 500,000 jobs a week now, and, you know, that's very, very disturbing, and that's why the consumer confidence numbers are low, and that's why the government's doing all they can to stimulate aggregate demand. However, we think we run the risk of bankrupting the entire country by continuing to add to this debt. Pete Peterson recently came out in his book that said that the average debt, if you include accrued liabilities for health care, et cetera, and this was before some of these massive obligations that we've taken on, you know, as backstops, guarantees, et cetera, it was about $460,000 per American household. There's just a massive amount of debt, and unfortunately it's going to create big problems.
Well, a year to this day, we'll bring you back on, but before then, certainly we'll see you again, David. Thank you very much. Good to see you.
I hope I'm wrong, but that's how we see it.
David Tice, bear market strategist at Federated Investors, calling for S&P 400 1 year from now.